Hello, and welcome to our latest video chat in the Money Show Expert Interview Series. I'm Mike Larson, Editor-in-Chief at Money Show, and today I have the pleasure of speaking with Meb Faber, Co-founder and Chief Investment Officer of Cambria Investment Management. Meb, I appreciate you taking some time out to chat with me today.
Great to be here.
All right, let's just start at the top, big picture first. Everybody's out there debating whether we're facing a Fed pivot, a Fed pause, more tightening. And on the economic front, everyone has different opinions about what kind of landing we face, hard, soft, or none. Where do you see things going from here, from your perch?
Well, if you look at the last few years, I believe there's been two regime shifts that largely are unaccounted for by investors. And so if we rewind back to COVID times, 2020, meme stock mania, culmination. Oh, it's a crazy time looking back at what was going on. We have an old tweet called "What in Tarnation?" So if we got any Southern people, this is a reference to my mom and grandma, but it's about 30 charts of just craziness going on. And we've all know what's unfolded since then. But I think when we look back with the fullness of time, we'll mark 2020 as the first regime shift, which was a shift, and you can mark it to kind of three different periods in 2020, but largely interest rates bottoming and inflation bottoming. But along with that, the value trade beginning. Said differently, that's when all the really expensive stuff started to get pummeled.
Yep.
So the cheaper stocks, much like late 1999, survived, whereas a lot of the expensive SPACs, things trading at 100 times revenue, did very poorly. As interest rates and inflation have come up and then back down a bit, at least on the inflation side, interest rates are still elevated and inflation elevated relative to history, but that's an environment most investors have not been accustomed to for decades, right? Most of us weren't around in the 70s, investing in the 60s or the 1940s. So it's an unfamiliar type of environment. But so the second regime shift that I think is particularly unaccounted for is the dollar peaking in Q4 of 2022.
Yep.
And so we've had one of the longest periods ever. I love the JP Morgan guide to markets that show these mountain ranges of foreign stock versus US stock outperformance. And historically, it's a coin flip. It's about 50-50 in any given year, which does better. But the US has had this massive, massive run over the past decade plus where people have largely forgotten about foreign investing.
Yeah.
So those two elements, I think, if you say, where are we now? I think a return to value investing, a return to a balanced global portfolio will suit investors well over the next decade.
In some of your recent podcasts, you've had guests, the noted real estate investor and grave dancer Sam Zell, the short seller Bill Martin, who had targeted Silicon Valley Bank, Mike Wilson. I know he's been one of the more bearish equity strategists over at Morgan Stanley. Are there some common threads that you're hearing when you talk to these people? I mean, I'm curious if you think investors are too bearish or not bearish enough, given some of the challenges out there, real estate banking and on the earnings front.
I think there was a comment that people repeated a lot over and over during the era of quote free money, which was, hey, look, stocks are allowed to be expensive because bond yields are low, and low being zero. And in other parts of the world, we're actually negative.
Yeah.
What a weird time. So looking today, you can walk down to your local bank, not First Republic anymore, but maybe a larger bank or your local community bank, and you can get 5%.
Yeah.
And 5% is a long way from zero. And so you've created this environment where a lot of the guests are talking about that, but they're also talking about the yield curve. Yield curve meaning, what does it look like for short-term bonds versus long-term bonds? And historically, when you have an environment where the yield curve is inverted, as it is now, it's usually not a warm and fuzzy place to be for stocks or the economy. It's usually a pretty high batting average recession indicator, but the assets that typically do best during a negative yield curve are T-bills and precious metals like gold, not the risk-on sort of environment that you would really want to see. So it's a time, I think, when most people are more cautious than normal. Pairing that with the fact that the broad U.S. stock market is still expensive, and it means you have some frailty with the broad U.S. market that I think a lot of people are concerned about, despite the really nice bounce we've had so far this year.
Okay. There was an interesting comment you had on Twitter. I was relating recently to bankruptcies and how it's overconsumption that tends to lead to that, not medical debt and so on. And that got me thinking just in general about the consumer environment. Some of the things I've heard are people concerned about auto delinquencies on the consumer side and real estate in particular on the commercial side. Any thoughts there? I mean, are these risks overstated, understated, probably about where they should be?
One of the things we know about us as humans is we didn't really evolve to be great at money. And one of the challenges too, if you give someone money, and we can see this with very large pools like lottery, but also even little amounts, is you tend to hedonically adjust, right? And so you get more money, you enjoy it for a little while, then very quickly get accustomed to that. And during COVID, none of us could really spend our money. We're stuck at home. Maybe you could spend on a Peloton, but then you're at home Pelotoning all day instead of going out to dinner. And so the challenge and a lot of the government support is, coming out the other end of that, you have this environment where people were flush with cash paying down debt if they had it, but you've now adjusted. And so then I think investors are going to face investors and individuals face a largely different environment of stress, and particularly people that have had exposures to the rise in interest rates affecting their debt. Some are fixed and hallelujah, good for you, but some are not. And we're seeing that with a lot of the banks, real estate certainly. And so these will have knock-on effects that could last for years. But as far as the Fed and the path of it, it's always a guessing game. Who knows what's going to happen there? But my happy hour guess or over coffee guess is that if you're the Fed chair, the only thing you care about is not repeating the mistakes of the Fed of the early 70s, which was they had some inflation, it came down, they thought they conquered it, they sat back and said, we're so smart, and then you just had a massive run up in inflation. And so I think they will do anything to avoid that mistake again this go around. So my guess is that higher for longer, they will err on that side.
Okay. Let's talk about, given some of the bigger issues in the macro view we talked about. I mean, what do you see as some of the greatest risks and greatest opportunities? I mean, you talked a little bit about foreign equities, for example, and then potentially commodities on that side. Could you expand on that a little bit?
Sure. Well, someone who's developed and implemented a beautiful global asset allocation, global stocks, bonds, real assets like real estate and commodities, has underperformed the S&P for just about every year for the past decade. And that's painful. And many people can only withstand about a year or two of underperformance before they start switching and chasing whatever the hot strategy is. And this has been the longest period we've studied in 100 years for an asset allocation portfolio. So a lot of that's a little too close to home for probably a lot of listeners, particularly financial advisors who have, quote, done the right thing. Now, the good news is, looking forward, that portfolio should be very well positioned versus something like just the S&P 500 going forward. Two of the three real reasons I mentioned earlier. One, the value trade is at one of the biggest spreads we've seen in history. So cheap versus expensive in the US. Mm-hmm. We run shareholder yield strategies that across the board are single-digit PE ratios. And have what we think is a much better positioning than the broad market. That's true also globally. So foreign, developed, and emerging, on average, the broad indices are cheaper, but the value stocks there are also screaming cheap. We're talking 5-6 PE ratios, dividend yields up north of 6%. We think that is also going to be a huge tailwind. And with the dollar being slightly overvalued, will be a huge reason to go foreign. Most people put almost everything in the US as US investors. So diversifying globally with almost half your portfolio in foreign stocks, we think is prudent. Bonds, great. They've reset up at 5% instead of 0. So that's a huge benefit to fixed income investors. And lastly, we always say it's important to have a real asset exposure. And that means real estate. So say REITs, we think it's important to have a value exposure there too. but also commodities and things like precious metals, particularly right now. Gold is knocking on all-time highs, and most investors have, I think, this crowd may be different, but largely forgotten precious metals and gold. But once we know anything about markets and investing, is when things are hitting all-time highs, people start to get interested again and chase performance. So gold, we think, could have some potentially explosive returns going forward.
Okay. I guess my last question would just be, I mean, I know we're about 3 months out from the symposium in Las Vegas you're going to be joining us for. Is there any kind of sneak peek or anything that you think you could give viewers a preview of what you think you might be talking about there?
Yeah, well, the world may be different in 3 months, so we'll wait till about the night before, and you can come ask me at the pool at the Pina Colada. But one of the ideas we've been to, our company has been around for 10 years launching ETFs, and one of the big flagship strategies for us is shareholder yield. And this is a
Okay.
concept that if you asked me 10 years ago, I would have said in 2023 the world's going to be different. Everyone will be using this approach because to me, it makes no sense to invest based purely on dividend and dividend income in a world where buybacks and companies are utilizing buybacks as an alternate cash distribution tool, that in any given year, buybacks outpace dividends all the way back to the 1990s. And so ignoring that vital piece of information, I think it's very suboptimal. And now we have 10 years of real-time performance to demonstrate how that's done in the US, how that's done in foreign and emerging. And it's a much more holistic view of how to invest in stocks. And so we'll probably dive into that topic, and I'm sure talk about 10 other things in Las Vegas too.
Great. Well, Meb, thank you so much for your insights, and thank you all for watching. If you'd like to hear more from Meb and really dozens of other top market experts, I do encourage you to check out our upcoming Investment Masters Symposium. It's going to be at the Paris, Las Vegas from August 8th to August 10th. It's a great event for high net worth investors. We're going to have keynotes, lively panel discussions, coffee breaks, cocktail hours, you name it. So, Meb, thank you again for your time. And anyone who's watching, you can click the link in the video description below to learn how you can join us.
Great to be here and see y'all in Vegas.
Perfect.